Imagine earning millions of dollars every single year while legally paying little to no income tax. For most Americans, that sounds impossible, maybe even unfair. The average worker gets taxed before their paycheck even reaches their bank account, while billionaires seem to grow richer every year without selling their assets or triggering massive IRS tax bills. But behind the scenes, many wealthy Americans use a powerful strategy known as buy, borrow, die. It's one of the most talked about wealth strategies in modern finance because it allows ultra-wealthy individuals to build enormous fortunes while legally minimizing taxes for decades. And the truth is, most people have never been taught how the system actually works. In today's video, we're going to break down the buy, borrow, die strategy in simple terms, explain why the rich rely on it so heavily, and explore how America's financial system rewards asset ownership far more than earned income. To understand this strategy, you first need to understand one critical difference in the tax system. In America, income is taxed aggressively, but unrealized gains are not. If you work a regular job, your salary gets taxed through federal income tax, payroll tax, Social Security, Medicare, and sometimes state tax before you even touch the money. But if a billionaire owns stock in a company and that stock rises in value, they usually pay nothing until they actually sell the shares. This creates an entirely different financial game for wealthy investors. Instead of earning large taxable salaries, many rich Americans focus on owning appreciating assets like stocks, real estate, businesses, and investment portfolios. First part of the strategy is buy. Wealthy individuals purchase assets that are likely to increase in value over time. This could include real estate properties, shares in corporations, private businesses, luxury commercial buildings, or large investment portfolios tied to the stock market. Over the years, these assets often appreciate dramatically. Someone who bought millions of dollars worth of stock decades ago may now control billions in wealth without technically generating taxable income. Their net worth rises on paper, but because they haven't sold the asset, the IRS generally does not tax those unrealized gains. The second step is where things become fascinating. Instead of selling assets to access cash, wealthy individuals borrow against them. This is the borrow phase. Imagine someone owns $500 million worth of stock. Selling shares would trigger enormous capital gains taxes, but borrowing money against those shares often does not create a taxable event because loans are not considered income. Banks are willing to lend huge amounts to wealthy clients because their assets serve as collateral. In many cases, the interest rates on these loans are lower than what ordinary Americans pay on mortgages or credit cards. This allows wealthy individuals to access millions of dollars in cash while technically avoiding income taxes tied to asset sales. This is why some billionaires appear to live luxurious lifestyles without earning traditional salaries. Their wealth continues growing through appreciating assets while borrowed money funds private jets, mansions, investments, and business expansions. The system works because the assets themselves often rise faster than the cost of borrowing. If someone's investment portfolio grows by 10% annually while their borrowing costs remain far lower, their overall wealth can continue increasing even while spending borrowed money. The final part of the strategy is the most controversial and also the most powerful. Die. Under current U.S. tax law, many appreciated assets receive what's called a step-up in basis after death. This means heirs may inherit assets at their current market value rather than the original purchase price. In simple terms, decades of unrealized capital gains can potentially disappear for tax purposes. Imagine someone bought stock for $1 million that later became worth $100 million. If they sold the stock during their lifetime, they could face massive capital gains taxes. But if the asset passes to heirs after death under current rules, the taxable gain may effectively reset. This is one reason generational wealth in America can grow so rapidly across wealthy families. Now, it's important to understand that buy, borrow, die is completely legal under existing tax laws. Wealthy individuals use teams of accountants, tax attorneys, private bankers, and estate planners to structure these strategies carefully within IRS regulations. At the same time, critics argue that the system creates enormous inequality because ordinary workers rely mainly on taxable wages, while the ultra-rich rely on untaxed asset appreciation. Supporters, however, argue that investment-driven wealth creation helps grow businesses, create jobs, and fuel the American economy. What makes this strategy especially powerful is that it changes how wealthy people think about money entirely. Average Americans often focus on earning income, while wealthy investors focus on accumulating assets. One side works for money. The other side works to own things that increase in value over time. This difference in mindset can dramatically affect long-term wealth building. Even outside the billionaire world, many financially successful Americans already use simplified versions of this strategy through real estate investing, business ownership, retirement portfolios, and tax-advantaged accounts like Roth IRAs and 401k plans. Of course, this strategy is not risk-free. Borrowing heavily against volatile assets can become dangerous during market crashes. If stock prices fall dramatically, lenders may demand additional collateral or force asset liquidation. Rising interest rates can also increase borrowing costs and pressure leveraged investors. History has shown that even wealthy individuals can face financial collapse when debt becomes excessive during economic downturns. Still, the buy, borrow, die strategy reveals something incredibly important about the American financial system. Wealth in America is often built less through salaries and more through ownership. The tax code heavily rewards long-term investing, asset appreciation, and strategic financial planning. And whether people agree with the fairness of the system or not, understanding how it works provides valuable insight into how the richest Americans continue growing wealth across generations. At the end of the day, the biggest financial lesson here may not be about avoiding taxes. It's about understanding the difference between income and assets. The wealthy often spend decades acquiring investments that produce long-term appreciation instead of focusing only on paychecks. And as financial technology, investing access, and financial education continue evolving, more Americans are beginning to realize that true wealth often comes not from what you earn, but from what you own.